Now, as we go through the refined products in detail, we always like to give the brief overview of USA products demanded. And we're always looking at the key drivers when because we have to use the average. Again, the EIA is data, it's imperfect at times, so it's always good to look at what is the average doing? Are we trending up? Are we trending flat or sideways? And again, we're continuing to trend sideways. And it's something where we're going to kind of waffle now within this range. We had a nice uptick in terms of gasoline demand, of diesel demand, but again, those are things that are going to be relatively inconsistent in terms of kind of where we are, which is why we think it's important to look at that normal trend. And if you look at 2019, it is, I think, a better gauge. As you can see here, we should start to see a little bit of a demand increase, specifically because we do have a strong, we're going to have a lot of grain exports. There's going to be a lot of movement, and we have seen some of that follow through, which we'll talk about in a little bit as we look at some of those big drivers. One of the interesting things that came out just now as we were preparing European diesel reverse. So typically the U.S. sends gasoline into Europe, but we're actually going to see some of that reverse. And actually we could see some European diesel show up in pad 1 just because of the arbitrage actually opening up backwards and coming the other direction, which is going to be interesting. And it speaks to the bigger overarching problem of diesel and distillate in general in the global market, which is why I think segment 3 is going to be important to talk about, what does that look like and how is that going to impact the US markets. So now that we've talked about that, let's really dive into distillate itself. And here you can see we actually had an increase in production. If you remember last week, we had, and the last 2 or so weeks, we actually had some distillate and kerosene being rerun to create a bit more gasoline. And now we're starting to see that ebb off a little bit. Jet fuel pricing has gotten a little bit better, especially in Singapore, which is, in terms of just where the shifts are. Distillate had a small draw of about 960,000 barrels. Again, it was really driven kind of pretty consistent between pads 2, 3, and 4. Again, that's something that we think is going to start to slow down. And when we start to see this distillate pick back up, it's going to be very weather dependent right now, especially as we get into November and December, as we look towards heating oil, and which is essentially diesel at this point. But when we look at the storage levels, you can see that we've now fallen back within essentially the top of that cloud, which is nice to see some of that slowdown. But again, diesel prices remain depressed. Crack spreads, continue to soften. And they've had a decent rally over the last, let's call it, 4 days or so. And we're starting to see some of that come off as, again, we have, the builds are still there. The draws aren't as aggressive as we would have hoped, especially when you consider where refinery utilization rates are, because the U.S., even though we had an uptick, we were still only at 77%. And yet we still have very slow declines, which is going to be problematic as we go through the remainder of the year. When we look at products supplied, we're right at that average starting back from 1991. When we look at it on just a 5-year level, we're still below that 5-year average, but we're starting to get a little bit closer to that number. Again, it's just based on where we have some headwinds, but at the same time, we have some tailwinds. As we go through the remainder of, let's just call it the next 2 to 3 weeks, some of the tailwinds will pick up, which will be supportive of diesel demand over the next 2 to 3 weeks, which will be a slight positive, especially as we go through the remainder of October. And this is one that I just wanted to highlight when we look at passenger miles, because it's interesting because we always talk about cars, but what about air and rail? And you can see that nobody wants to be on an airplane, and nobody wants to be on a railroad. And that's going to be a continuation, which is going to be a longer term issue, especially as we go through the remainder of the year. And then as we start to gear up for 2021, and we start getting estimates for where demand is going to be, it's the question is, are we really going to see those rail miles change or those air miles change? And it's just one of those going to be those bigger headwinds, especially as we look at, how do most people in Europe travel? Well, it's by rail. And how is that, because that really is the most efficient way if you consider cars structure. So that's something that we're going to start to look at in a bit more detail in terms of what are their rail miles doing? What do the passengers look like? Because that remains a headwind. And here it's just interesting because you can see the bounce in vehicle miles. But again, we're well off of where the peaks are, and we're more in line with where we were in 2012, 2013. So as we go through, we like to look at, so Google updated its data. As you can see, they updated it and there's really no change. Things kind of are sitting here in this weird paradigm of avoidance of excessive travel. And that's one thing that's going to be actually a bigger focus in tomorrow's economy show, as we start to look at how people are looking to shop for the holiday season, and is it going to be slower than normal? And obviously we're going to say that it's going to be a bit slower than normal. But again, that's not just gasoline, that's also diesel, because we're already starting to see imports slow down a little bit. Exports are obviously down, and we're going to actually talk about the U.S. trade balance, just because the imports are starting to slow because supply chains are now starting to catch up. So that's going to be a slowdown in diesel, again, as we go through the remainder of Q4, because as we see here with our internet truck shop market demand, demand remains high. So clearly there is still some of this demand that's being pulled through. We were expecting, just based on some of the other data points, that we were going to pull back a little bit and come closer to that 100 mark. Again, we were wrong, and here we are. We have some additional demand. It's pulling more diesel through, and if you look at just where the load availability is, we're now essentially above the 2018 highs. And it's just coming through, refilling that inventory. We've seen inventory growth. So we're on the downstream side, we're seeing some of these businesses, they're starting to rebuild. They're getting closer to where they were. And then again, that's going to slow down the overall pull through. But again, we still see, and I'll make the call again that we're going to see a little bit of pullback. But again, we're not talking about a pullback below 100. It's just something closer to that 100 level. One of the interesting ones is freight rates have come down a little bit. If you look at where specialized trucks and refrigeration, they've pared back. Again, it's diesel prices are still cheap, so this is really being driven by demand and by just shortages of trucks available. And that's, you can see that in terms of truck availability, which is now below the 2018 and the essentially 2008 to 17 levels. So we're still seeing that, which is, again, that tightness is creating that pricing. That pricing will start to slow down some of the demand. And as we have some of these pricing metrics that are going to be working throughout the remainder of Q4. Now, when we look to rail traffic, again, we've been talking a lot about grains, and you can see how strong the grain market is. Year to date, it's still below, but it's gaining steam, and it's gaining steam quickly. And again, we're going to talk about that in the economy show as we look at just where that demand is, and China just continues to come and grab as many as they possibly can, because there is that food shortage on a global level. One of the nice things to see when we start talking about where is the U.S. economy, where are things shifting, we're seeing a metallic ore and metals increase. And if you remember last week, we talked about how we saw some price cuts. We saw some of those being moved through, and we were hopeful that that was going to pull some additional demand in and get guys a bit more active. And you can see that that did pick up, and it's something that we should see continue through. Intermodal is elevated versus this week versus 2019, again, where it's up about almost 7%. And total traffic, we're getting there now in terms of almost 1% over last year. Total car loads are still down, but again, if you think about trucking, there's more on the truck, so there's less total car loads. But in terms of traffic, we're actually starting to pick back up. Year to date, we're still down 10.4%. So again, this is a nice little push into the end of the year, but it's something that we think is going to slow down, especially as we have the imports starting to slow, exports remain slow, and some of that inventory starts to get rebuilt. And it's going to come down to how strong does the final push for holiday shopping really look. Now, pivoting a minute into gasoline, we had a draw of about 1.5 million barrels, and you can see it was really driven by PADD 3. And the one thing that we talked about last week, we were bullish, even though some of the data was skewed. Some people were saying that imports were going to fall. We still saw a big increase in imports, and you can see that we did have a big spike in imports of gasoline into PADD 1. That now pairs back. That'll slow this week into next week, and because of the arbitrage really shut down last month, this is a lot of residual, and we haven't seen much really adjust. Over the longer term, we think the only way the European refiners can try to protect themselves some way will be to increase exports. So that's something to watch in terms of exports coming into the U.S. gasoline market. So we're always going to have that flow into PADD 1. Here, if you look at total storage, you can see that we're still, it's nice to see we're in this level. If you look, we're actually slightly below the 5-year average. So yay, some of this is going somewhere, and it's just going to be a matter of what do we look like as we go through the remainder of the year, which is something that we've been saying. We think it's going to be flattish to down, but not down a huge amount. It's just, slowing down as we see COVID cases increasing, work from home adjustments, and those are going to be those small adjustments that will just be that overhang for total demand. PADD 3, we had an increase in exports, so that was nice to see, getting some of that off the coast. It's just that's going to be lumpy, especially when we consider what's happening on the hurricane level. So we would expect to see a little bit of an increase in storage, but as you can see, versus year over year and the 5-year average, the PADD 3 is still elevated. So they want to work off some of that additional overhang. And here is looking at the total products, gasoline demanded. We had a nice spike. Again, it's something where we have to consider the ebbs and flows. The gas buddy data, which we'll talk about in a minute, has been very supportive in terms of just kind of maintaining a little bit of this growth. Again, we're still out of the bottom of that cloud, but getting closer, which is nice to see. Again, we just think that there's going to be some pressure, especially as we go through and get into a little bit colder weather, and then some inclement weather will slow down some of that demand. Now, here as we look at the gas buddy data, you can see that we've had a pretty steady increase over the last couple of weeks. 8 straight days, actually, of week-over-week increases, which is, again, nice to see. Again, coming from Gas Buddy, if you want to follow that on Twitter, highly recommend it. It's put out. The gentleman that does it is fairly good at being very up to date on it. And just to give some color, it's Patrick Dehane, very good at just putting out some great color. And then as we look into Tuesday, demand was up again 1.1% week over week, making it that 8 straight days. So when we think about the movement of gasoline, the EIA is picking up what are the refiners doing, what is storage doing, and this is picking up what is the consumer doing. So you can see the whole supply chain has shifted in a positive direction, and that's something to watch. And you can see that, as we look at last week, Gas Buddy data showed retail gasoline demand up 3.24%, and the EIA up about 4.3%. So again, getting close. So we'll continue to see that pull through. The hurricane will impact that driving demand, so we will see that lumpiness. But again, it's something positive to see. Now, on the less bright side is jet fuel. Jet fuel demand just continues to go sideways. We don't really see much in terms of movements. You can see that some of the stocks fell a little bit, but again, it's just a matter of moving that kerosene into something else, and just based on where some of the demand is. So kerosene can go into the distillate or parts of the gasoline pool. You'll start to see that continue, especially given some of the demand. But you're already seeing it where demand is up, but storage of gasoline isn't really coming down all that much. And it's because refiners are trying to find the best way to move some of this product through the system, make sure that storage remains robust, but at the same time moving things through, because gasoline does have an age limit in terms of storage. Again, it's 6 months or so. It could be longer. So it's just something to consider as you want to continue to cycle through some of that volume. BNEF put up an update in terms of global airlines. They continue to cut flights through November. That the new dark lines, that dark blue line shows the U.S. in terms of that shift down. As we kept saying that everybody was way too lofty of expectations as we were in July. People felt good coming out of May, June. The view in July was that we were going to see additions in August, September. We kept saying, look, the data doesn't support that. People are adjusting. Companies are shifting to carbon neutrality. And what's the easiest way to get that optic? Again, it's going to be air travel. So that's something that we're continuing to shift down. And it's important to appreciate it's not just the U.S., it's APAC, it's Europe, and so the rest of the world, and you're continuing to see those shift lower. And it comes down to just avoidance of COVID, saving costs. So that's on a corporate level, that's on a consumer level. So this is something that we think is going to continue to be sticky and be a bigger overhang, especially as we go into 2021. The TSA passengers continue to support that. Again, we remain confident in our range of 550 to 750. There's not much to really shift that. And I think the actual volume of flights is supporting that. They're also expecting this to be more of a consistent range going forward. The interesting thing is going to be this TomTom data. Again, we like to kind of highlight what is TomTom data showing, and the U.S. is showing a small slowdown. So this is going to be something that we think is going to weigh a little bit, especially as we go into the rest of this week and into next week. And again, it's just because we've seen some COVID increases. Some people will just adjust travel, and this is starting to show some of those adjustments. The bigger ones to watch, obviously China has Golden Week. It's not surprising to see that people are now where they're supposed to be, so you're seeing that come off. The bigger one that we want to look at is going to be India. So India, again, this is, one day isn't a trend. So we just want to look because we've gone from down 29%, 33%. We're starting to increase, and now we had a big down 70%. Again, it's going to be a matter of what is that consistency. The ones to look at as we shift away from Asia and we shift into Europe is going to be France and Spain, specifically as we've had increases of COVID cases. And how is that going to impact driving data? Because you're continuing to see some of that slowness. And that's why, and you might say, why are we talking about Europe and Asia when we're talking about the U.S. and refined products? And it comes down to imports, because this is something where we think we're going to get some of this flow. And again, that's going to also impact our exports, which will go into greater depth in segment 3. Here's the open table data, and not much to report. We've been saying kind of that 45, down 45% is that peak to the downside, averaging something closer to 30, down 35%. Again, you can kind of see that we're holding within that pattern. This will start to get a little bit worse as people have to shift indoors. And it's just a matter of, I don't know if you own a restaurant, if you're watching us, we'd actually love to hear can you get propane heaters? Because the commentary that we've heard is good luck getting one now. If you want to order one, it'll be delivered November of next year. So it's just getting you an idea. People have already tried to build that means of just heating. And then it'll be interesting to see how does that adjust propane demand, especially as we go into the remainder of the year. This is just giving the backdrop in terms of where do we have the open table regional breakdowns. Again, the U.S. is within that kind of confidence range. Over the weekend, we had that increase, which we continue to see as people look to get their last hurrah, if you will, of outdoor dining before they have to shift inwards. Germany, we're starting to see a little bit of a slowdown, and that's starting to reflect a little bit more. But as we talked about, the government can say a lot of things, but the populace doesn't have the same buy-in. So even if you say something or enforce something, it doesn't mean people are going to adhere to it. And we're starting to see that in France, in the UK, and not so much in Spain to the same degree, but UK and France. So we're not going to see the same type of slowdown, but again, people will just naturally adjust to avoid unnecessary contact. And then just rounding out, we like to talk about the MTA, and here you can see MTA entries are just kind of holding firm at this level. And this is just an indicative of what's happening in other cities where people are still avoiding offices, people are still staying at home. And as we talk about in the economy show, we're going to start to look at, well, how is that changing spending patterns, not just on the way you go to work, but also on the way you purchase. And we continue to see that shift to e-commerce, which is going to continue. And again, this is going to keep tourists out of, this is showing tourists aren't in the cities. People are avoiding mass transit, which is something that we're continuing to see, which is just going to weigh on just how active can these cities get. And then that leads into cash flow, tax revenue, which again is going to be that overarching overhang as we go through 2021, which is just going to be that problem as we look at refined product demand, which we think is going to have that overarching overhang and really sit at kind of that plateau level that we've been talking about.